Welcome to Power Charting. I'm your host, Bruce Fraser. With me today is guest co-host Johni Scan. John, thank you for being here.
Great to be here, Professor.
Hey, we're going to talk about stocks on the edge. And this is really kind of a continuation of the episode from 2 weeks ago. And let's bring things up to date. And then Johni Scan has a scan for us, which is pretty interesting. So just an announcement, the weekly Wyckoff market discussion next week is going to be, on October 19th, is going to be a free session. And so this is a lot of fun. Roman Bogomazov, myself, Johni Scan often attends and presents. And we are going to do a special free session. Sign up at wyckoffanalytics.com. We do not share your information. Just come join us and have a good time. John, what's your experience with the WMD?
It's phenomenal. It's gripping market data every week, same time, same place. And it's just a fantastic value for people.
I couldn't have said that better myself. So,
well, you can quote me on that.
Well, this is a chart from the end of the quarter. I showed it last time, and which was 2 weeks ago. And as you can see here, we were throwing under this trend channel that really was established, the stride of it going back to December and March, April, and then with an oversold line here, the dotted line. And we are again below it, which could be a sign of acceleration. This is one of the reasons, John, that I'm talking about this potentially being on the edge, and that this is a very precarious place for the market. And so I want to show you a chart here, an update. And this is kind of my working Wyckoff chart. And John, look at that big gap down right there. That is the CPI opening that we had today. And this is October 13th. And then for broadcast, October 14th. What do you see here, John?
Well, I think the horse and the cart have gone over the edge. Yesterday on the edge. Today might be over the edge. What do you think, Professor?
Well, couple things, and I do have an analog that we can look at here in a few minutes, but I do want to point out again that these quarter ends are exceptionally important, and you can see the lows and the highs seem to nest or cluster at these quarter end periods. And here we are, end of September, quarter end, and we're now down in early October below this downtrend channel and with a gap. So if this is a low, and it doesn't have to be, it could be an acceleration down, then it needs to get back up into this channel in short order. And let me show you another example here of being on the edge. If this is the secular uptrend of the S&P 500, we've looked at this chart numerous times. We first looked at it up here when it climbed over the top of the Keltner and the channel. And these are where the channel line anchor points are. And we are now below this secular uptrend. And John, I had an interview with Martin Pring at ChartCon this last weekend, which was an absolute blast, the whole event. And he believes that we are in a secular shift from an uptrend, a bull market started in 2009, let's say, and has been striding up ever since. And now we're clearly, based on this channel, breaking that down. And we need to get, as it did at the COVID low, back into the channel in very short order, or we have a real throw under of the channel at this time. And so, John, what are your thoughts?
Well, two things. Number one, our next point of major support seems to be at or near the COVID lows. So that's a long way down. Second, in the overthrow of the channel, we actually had a small head and shoulders formation. And we have gone so far beyond any move from the neckline and the traditional measurement sense that something is different, because the measurement that we would use from the head and shoulders just seems like it blew right through it.
Sure, the vertical distance between the neckline and the head there.
Right, we're
Yeah.
maybe 3 times past that, so maybe there is something larger going on, and certainly Mr. Pring, I take his words to the bank, no question.
Yeah, and so it's very much worth watching that interview. And at the time that this threw over these two really important overbought points, we put this chart on power charting and talked about it and said that if it didn't stay up here and came back in, it could be a very volatile decline down to the oversold condition. And now we're actually below that and below the channel itself. So this is a precarious place. And I just want to point your attention here to a similar condition back in 2008, where it broke down out of its uptrend channel, tested it, and then failed. And it went all the way down to the lower Keltner, but didn't stop there. That was the beginning of where the big trouble was. So there really is a precedent here for the volatility being able to become much greater in a secular downtrend. So we want to be very, very careful about this. Now here, John, is the same with the NDX 100 as our secular uptrend. Big throw over. We've looked at this chart numerous times. These red arrows are the oversold points. And look at what we're doing here, John. What do you think?
It looks similar to what we're seeing in the other index, and we're below the bottom of the channel line into an oversold position. And quite frankly, the Nasdaq, the Qs, they are looking among the weakest sectors and indices right now.
And also, these arrows, you can see that there was a throw under of the demand line. This is traditional construction demand line over bought line. And so here, throw under, here, throw under, here, throw under, about comparable to these. So we can look for a rally up into the channel. Like I said, it doesn't have to happen, but it's something for us to keep in mind as we go forward with this market. And let's go to the green shoots. And John, as we've talked about in the past, these green shoots are really important because they often precede important rallies. And this is the Nasdaq comp. This is the Nasdaq advancers minus decliners on a 10 period. I put 5 here, but I decided to make it 10. So I'm sorry I didn't update that labeling. But I want to point out, well, there's 2 things we look for. We look for divergence, which is an upward stride, higher lows against lower lows in the market, and then a rally, and then a rally. And so we want divergence plus directionality. And so far, you can see just right down here, let me blow this up. You can see that this area right here is the CPI breakdown today. And here is the higher series of higher lows. And this is higher than this, than this. So we do have the emergence of a minor divergence. We don't have directionality yet. So John, your thoughts?
Well, it's a scary ride right now. Frankly and truthfully, it's a little bit scary because it's one significant drop after another, weaker rallies, bigger drops, all the things that perhaps are approaching climactic action to the downside. Maybe we get relief in the future. I don't know.
Now here we have the New York, this is the S&P, this is the New York advanced decline. So a little more traditional maybe, and low, higher low, higher low so far, gap down. So this is the reason I say that we need to reverse this up in short order and start to move up potentially calling this an exhaustion gap and a reversal, a spring type reversal, to be able to justify this as a true divergence. And that's the directionality part. And so far, it's not there. So we want to test for this just as we saw it here and just as we saw it here. And so there's just an update on green shoots. And now I want to get into something I talked about at ChartCon, and that is the trend model. And so I'm a big advocate of campaign investing over extended period of time. I spend a lot of time looking for stocks that are in robust uptrends. And I talked about that in my sector talk at ChartCon. And I actually showed a scan that I used to be able to dig out these best scanning ideas. And so here I just want to orient you towards the way it works. And then we will go to, in future episodes, we will go to actually seeing how the scan works. Won't do that today, but you can see here in the case of XLI, this is the industrials sector, that what we look for is we look for a rising 39-week moving average of price, which is this top cell. And then we see confirmation of a rising price, but we also look for rising relative strength. And so that's the relative strength being above a rising 39-week moving average. And I call that an in gear up relationship. And so when we have in gear up, now we have the conditions for a long-term uptrend. This trend here lasted in price 2 years. The relative strength started to fail about 1.5 years in, but you can stay with the trend as long as preferably price continues to be above its rising 39. Here you can see a dip below the 39. As long as the 39 doesn't turn down, you can give it the benefit of the doubt, because we are trend following here, and let it continue. You can see the same condition here. This is 2016 to 2018. And again, a nice 2-year uptrend, rising price above a rising 39, rising relative strength above a rising 39-week moving average of relative strength, in gear up. And so as long as that condition exists, then what I would do is I would go in and look at the sector and look at the preferred stocks in the sector, look for the leadership. And this is one of the things, John, that I want to do in the future, is for you and I to develop scans for our people that look for this emerging leadership.
Not a problem.
Cool. And so now let me just show you an example so you can go through and peruse this. Currently, you can see relative strength is up. A lot of stocks have this condition, above a rising 39, but price is below. See how the price rallied up into a declining 39 and started back down again. We don't have an in gear up relationship. So let me take you to another one. This is Werner. This is the trucker, but let me take you here to Scott's Miracle Grow. I think it's a great case study, because, and just screen capture this or make your own chart, and you can see here in gear up. This is 2016-17 price and relative strength. And then note that the relative strength starts to fail and turn down prior to price. And right here is where price starts to turn down from its uptrend. You have to be out when both conditions are down, and price and relative strength are below their declining 39, which happens right about here. Here, everything's in gear. Look at this beautiful uptrend. In gear up, and up it goes. And then right here, you can see a breakdown in both pretty much simultaneously. And you get a turn down of the moving average right here, and right here a little bit earlier in the relative strength. So the relative strength turned down right here. You have permission to sell when the relative strength turns down. Those are my rules for me. So anyway, so just to orient you, and then look at this decline. This is why you never want to be in an in gear down situation in the market, is because of this. This condition can just be really a long, persistent decline that can just really destroy capital value. So, and then with that, this is a good place to stop. We're going to come back to this again in later episodes, and we are going to have John show us a scan. Be right back. Points to make regarding the S&P, and we'll do this as a scan in upcoming segments, is that if we do a scan on my trend system, only 11% of stocks in the S&P 500 are in confirmed in gear up states right now. Very low trend breadth, I call it. And we will look at how to do that in future episodes. In a bull market, that number can be in the 60s and 70% range, meaning more than 70% of S&P stocks can be in a confirmed uptrend in a raging bull market. And so that tells you, gives you a really good idea what the breadth situation is. But we continue to look for these stocks because the 11% of stocks could very well become the leadership when the market turns back up, whenever that is. Second point I would make is that go back to the power charting from 2 weeks ago, the last episode I did, and I did an analog to the 2018 fourth quarter in the S&P, which I think has some similarities to now. And look at the tactics for how you deal with being under the ice. And we're defining the current situation as being under the ice and using that 2018 analog as sort of a model for how this thing could turn out. So anyway, 2 quick notes on that. And so, John, we're looking at a scan here. What do we have?
Absolutely. This scan searches for potential green shoots. We talked about green shoot for a second. We saw some arrows on the charts. Let's see if we can find something resembling that. So what we have here is a group of indices, mid caps, large caps. I've excluded small caps for the time being, but you can simply remove the comment marks and that would give you the S&P 600 small caps included. But we have the ability to take rate of change and apply it to price, in this case over 21 periods, less than 0. So slight downtrend or more in price, but we can also use rate of change at super syntax, meta syntax, I call it. We can apply that syntax to other indicators, in this case, the MACD line itself. So over 21 periods, the MACD line is has a change above 0. It's moving up. We can also use that to rank our results so that we have the results, which in this case would be the biggest results first. The MACD line has the biggest change over 21 periods. That's the one we're going to see first. So if we take a look at when we run that scan, 131 results out of almost 1,000 candidates. So just about 10% coming back as demonstrating green shoots. We see a variety of scooter values, sectors and industries, and we did indeed get the sort we wanted, which is the largest rate of change on the MACD 21 periods first. So in StockCharts, you can manipulate the sectors and industry groups just by clicking on the column headers as well as any other column header that is available to switch up your returns and help your analysis. But you can also drag and copy the whole thing over to Excel. And we just show you real quick. Once it's in Excel, you can group by sector. You can work this in multiple levels and very interesting groups. Here's the industrial group that you were speaking about, Professor. A lot of industrials in the green shoots sector. What do you think there?
Yeah, absolutely true. And the relative strength on these industrials in many cases, as a matter of fact, the sector itself is above a rising 39, but price is not, as we showed on the chart prior. But that does tell us that there's really an attempt for industrials to try to persist as leadership. And so that could be where the early emerging trends are when this market does decide to turn around.
The one sector that was a surprise in this sort was, look at all the tech. Look at all the semis in there. So very beaten down sector, but yet showing some green shoots. Let's take a look at some charts. Here is from the banking area, F.N.B, and we see a rising MACD, declining price action, rising RSI. RSI is on this chart, so you can compare what the RSI and the MACD are doing, but look at the nice uptrend in our relative strength. What are your thoughts there, Professor?
Sure, and that is a shorter term relative strength line, not 39 weeks, but 50 days. So just keep that in mind. But you got to start up at 50 days before you can go to 39 weeks. And so that's a really good early warning. Also, look at that beautiful hinge from August to October. And oftentimes a hinge, it's got to confirm itself by coming out, but often a hinge is just a period of indecision before going typically in the direction it was going in before the hinge started, which would be a new uptrend potentially. So we will look for confirmation of that.
Another one we have is Robert Half from the industrial sector. Now here we've got the blue lines on the page. Those are cycle lines measured at 21 periods. So if you're visually analyzing your charts to make sure that the scan engine gave you what you wanted, you'll see that indeed over 21 periods, price is running down. The MACD is very close to zero on it, but that was the requirement, that it simply be a positive slope over a period of time. Relative strength up, MACD as well, and RSI. OBV struggling to come back, but an interesting picture here, cause forming. Your thoughts?
Well, what we look for with the MACD is a rising stride, which we do have in September and October. And then when it outright crosses the zero line, you really have the conditions to start a really good uptrend. So pretty interesting place for this MACD relative to the stock itself, and potentially an accumulation structure.
Yes. One from the oil patch here, equipment and services, Halliburton. Interesting possible shakeout in a post-distributional structure. So that has an interesting potential character to it. RSI, MACD both up and just peaking up over a downsloping SMA on the relative strength. Maybe we have something here. Oil's up today despite the CPI number, and others in that sector are actually gaining ground today.
Note the end of 2021 on the left side of the chart. MACD goes positive. It's in a rising stride. And look at the kickoff of a very important uptrend for Halliburton, and probably one of the better performing stocks of 2022. So just a great example of what we were talking about.
Here is from the gambling area, discretionary. There were quite a bit of discretionary stocks on this scan. And here we have really a distributional type look in the middle of the structure. But we did meet the other requirements for the scan. The orange line represents the possible correct level to consider for overhead resistance. But it also is forming a structure low. Your thoughts here, Professor?
The only thing I really have to add, it looks like potential accumulation, but I don't like the way that it upthrusted at the beginning of the new quarter in October, and then immediately failed and had a couple of big distributional bars on volume. So I would be very cautious about this stock until it shows signs of wanting to make additional higher lows and get above resistance.
Down hard on increasing volume, not necessarily where you want to be long. Option healthcare, XLV for the sector, healthcare. And interesting here, up on all of the major indicators on the chart, and we just had a positive cross of the EMA 12 or the 26. Your thoughts here, Professor?
Just it looks like jumped out. It's in a reaccumulation. Love the way it's having a really vibrant rally and very shallow reaction so far in September, October. And then also when it gets above the zero line on the MACD on a rising scale, which it's now doing, it seems to want to go into a nice uptrend. So a great example.
That's all from the scanning world today. Thanks so much for having me on, Professor.
John, thank you so much. It was a great presentation, and we'll continue on in weeks ahead. Thank you.
Right. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.